Hello. Today you will learn about one of the most common forms of investment, so about the bonds. This is the instrument recommended for those who are either looking for a low to medium risk asset in their portfolio or are looking for a medium-term solution. But to be able to use it, you need to know what it is. So first of all, let's look at what a bond is. A bond is a negotiable debt instrument. It is nothing more than when you lend money to the issuer of a bond, like a bank. It differs from a normal bank loan in that, on the one hand, anyone can buy the bond, so anyone can be a lender, not just the bank. On the other hand, the amount needed is not provided by a single financial institution, or even a small group of banks, but by a large number of investors. And thirdly, if you find a buyer, you can sell the bond before maturity. Next, let's look at some of the more important basic concepts about bonds. The issuer, believe it or not, is the one who issues the bond. It cannot be an individual. It is either a company or the state itself, or perhaps a large municipality, that acts as the issuer. Corporate bonds are issued by the former and government bonds are issued by the latter. The face value is the amount on the bond. The issuer agrees to repay this amount at maturity and to pay interest on this amount. The coupon is the interest rate paid on the bond. It is given on an annual basis. Maturity is the date on which the issuer repays the face value of the bond to the current holder. You may ask, if there is a bank loan, why would anybody need a bond? There are cases where the issuer of the bond needs a lot of money, either for a specific purpose or for a general, free-flowing need for capital. The most obvious way to do this is to ask a bank or a group of banks to lend them the money. However, banks have a limited willingness to take risks and may not lend more than a certain amount, even to a very well-rated client. If this otherwise good investment cannot be made even if several banks join forces, then the investors come into the picture. Then, instead of one or two lenders giving a large amount, many small lenders give a small amount. This is good for the investors and the issuer's goals are achieved. Next, let's run through how the bond works. When subscribing for a bond, the issuer specifies why, under what conditions it is issuing a bond. You can then decide whether to give them any amount for this purpose. If you do, the issuer of the bond undertakes to pay you the face value and the predetermined interest at the time and in the manner specified. Interest payments are usually due annually, so you may receive some amount each year on the face value. The rate of interest can be set in 3 different ways by the issuer, and you will receive money accordingly. The interest rate can be fixed all along, in which case you will always get the same amount. It can be variable, in which case it may be linked to an external factor. For example, you can say that the current inflation rate is plus 1%. With a variable rate, you can also link it to something fixed. For example, they can say that they will pay more and more interest over time, so they will index the interest rate. Discount securities are a special way of paying interest. You do not receive interest, but the issue is made at a price below par. You benefit from the difference between the amount paid at issue and the nominal value you receive at maturity. Let's look at some interesting things about bonds that you should be aware of before you invest. Let's start with the related rights. In a company, capital can be raised by issuing shares or bonds. As a shareholder, you are the owner, which means that you own the business to a certain extent. Just like any other property you own, you can dispose of it. As a bond is a debt instrument, you have no say in the management of the company, even if you have invested a significant amount of money. In other words, bonds give you creditor rights, not ownership rights. In return, you can claim interest payments even if the company is not paying dividends. Of course, if you want ownership rights in addition to the creditor rights in the company, there is nothing stops you from buying shares and bonds in the same company. Debt rating, so the valuation of issuers, is also an interesting issue. Obviously, if you have already put your money on bonds, you want to get the highest possible interest on your investment. But remember that a higher interest rate also implies a higher risk. A measure of this risk level is the debt rating. Bond issuing companies and governments are assessed annually for their creditworthiness. There are several debt rating companies. You have probably heard of Moody's or Standard & Poor's. They're the ones who tell you how stable an issuer is based on how it has been managed so far. Of course, there is no flawless system. They can be wrong, or there can be an unforeseen event that overturns the forecast. In any case, it pays for you as an investor to take what they say seriously. It is true that you may get a higher interest rate from a weaker issuer, but if it goes bankrupt, not only will you not get a higher interest rate, you may not even see your capital back. It is true that, for an AAA issuer with a high rating and a lower interest rate, on average 1 in 1,000 will go bankrupt in the 10 years following issuance, and for CCC, or basic risk, this affects almost 1 in 2. This is true for both corporates and sovereigns, as there is a concept of state bankruptcy alongside the corporate bankruptcy. The third is the benchmark. A higher risk-adjusted excess return needs to be benchmarked against something. A benchmark is good for this. This is usually the yield available on government bonds issued in domestic currency, so here in Hungary and foreign. This is compared to the yield of other bonds. Let's look at how you can invest in bonds. If you have decided that bonds have a good place in your investment portfolio, there are several ways to get them. The first, and most obvious, is when you buy the bond when it is issued. And at the end of the successful issuing period you will receive your bond. You then pay either the face value or, in the case of a discounted bond, the discounted value. Since the bond is a marketable security, the second way to get it is to buy the bond from someone who has already have it. This is called the secondary market. You will then buy the bond at the current price, which will be different from its face value. The current exchange rate is influenced by several factors. Things like how long until the next interest payment, how many years until maturity, and other investment opportunities. A third way to invest in bonds is to invest in a mutual fund that includes bonds. Of course, you will not receive any interest, but you can invest in more bonds in a single step, thereby reducing your risk. Speaking of risks, let's look at these two. Because like all investments, bonds have risks. One of the main risks is issuer risk. Even though the issuer has agreed to repay the face value of the bond, if it has liquidity problems at maturity, it is questionable when it can pay you. If it ceases to exist due to bankruptcy, you could be chasing your money. The second risk is interest rate risk. The longer the duration of a bond, the more sensitive its price is to changes in the central bank rate. If the base rate goes up, the price of the bonds can go down. Last but not least, exchange rate risk is one of the main risks. Of course, you can buy bonds not only in foreigns, but also in any other currency, and if you buy bonds within an investment fund, they are likely to include foreign corporate bonds. The exchange rate risk affects you on two ways. One is the risk of a shift between the actual currency and the foreign. In this case, the face value is denominated in the issuer's own currency, say euros or dollars. But you will typically pay for this in foreign. If the foreign exchange rate moves significantly compared to the buying rate, your return will be either positive or negative. The second point will only affect you if the issuing company is significantly downgraded. Then some investors will look for a safer option and sell the bond. They are not the only ones who may decide to do so, but the investment funds that buy the securities of the company in question may be obliged to sell the securities of the downgraded company, irrespective of the price, in accordance with their investment policy. This can result in significant exchange rate losses. What is the right solution for you in such a situation? I cannot say from here. You can also decide not to take the risk and sell the securities, even at a loss. But if you are confident in the stability of the company, you can also decide to wait, in case the world order is restored at the next annual valuation. If you have even more confidence in the company, you can even buy at a low price. You will then receive the bonds at below par. At maturity you will receive the face value and interest will be paid on the face value. In other words, if the company stays afloat, your available yield will increase.